This chart illustrates the U.S. trade in goods with China since 1985. Over the last 5 to 6 years, the United States, once heavily reliant on Chinese imports, started to question its trade relationships. The U.S. began seeking alternatives and diversification due to concerns that China might soon dominate the global order. During the first 6 months of 2023, U.S. goods imports from China fell sharply by 25% in this continuing trade war saga. Mexico seized a lucrative business opportunity, eclipsing China from the top spot and claiming the crown. Factors such as pandemic-induced inflation, escalating Russia-Ukraine tensions, and heightened trade tariffs due to the China-U.S. trade war collectively propelled Mexico to this #1 position. Benefiting from its strategic geographic location, Mexico serves as a crucial transit hub linking North America and Latin America. Its 2,000-mile border with the U.S. boasts 47 active entry points, facilitating streamlined supply chains, reduced logistical complexities, and expedited response times. The U.S.-Mexico border witnesses a staggering flow of over $1.2 million in products every minute, establishing it as the busiest border worldwide. From China's primary port in Shanghai to Los Angeles, a key gateway for Asian exports to the U.S., spans 6,500 miles. Conversely, the distance from Ford's Mexican car manufacturing plant to Los Angeles is significantly shorter, covering just 664 miles. Trucking goods from Mexico to the U.S. takes less than 12 hours, underscoring Mexico's advantage of faster and more cost-effective transportation compared to China. In close proximity to the U.S. border, Mexico hosts numerous manufacturing facilities, allowing U.S. companies to relocate production and significantly shorten the distance to market. Products manufactured in Mexico can reach any part of the U.S. within 5 days by truck, a stark contrast to the cost-prohibitive option of flying Chinese imports to match this delivery time. Under NAFTA, Mexico has consistently ranked among the top 3 trading partners of the United States. Its global manufacturing reputation hinges on maquiladoras, factories established mainly along the U.S. border since the 1960s. This model thrives due to Mexico's abundant mineral resources, favorable demographics, competitive pricing, available workforce, and reliable parts suppliers. Contrary to appearances, Mexico's supposed geographic advantage over China is not entirely accurate. Despite its portrayal as a country plagued by cartels, crime, economic instability, poverty, and inadequate infrastructure, Mexico's economic uncertainty intensified with the advent of the Trump administration. His America First policies and vocal rhetoric strained U.S.-Mexico economic and political ties, eroding investor confidence and triggering significant peso depreciation, which fueled inflation in 2017. Internally, the election of leftist populist politician AMLO in 2018 added another layer of uncertainty to Mexico's economy. Despite these challenges, what many may not realize is that over the years, Mexico has demonstrated remarkable economic resilience through its adaptability. With more than 25 years of integration into North America's productive region, Mexico has established an extensive network of top-tier suppliers connected to global manufacturing supply chains. Since 2017, U.S. reliance on Mexican goods has surged, particularly following the enactment of the U.S.-Mexico-Canada Agreement in 2020. For instance, during the first 3 months of 2023, foreign direct investment in Mexico spiked by an impressive 48% compared to 2022. Notably, the manufacturing sector's share of FDI doubled from 24% to 53%, with half of all new investment dollars flowing into Mexico. In the first quarter of 2023, investments in heavy machinery in Mexico from Canada and the United States hit an all-time high, skyrocketing over 200% in just 2 years. Across the border from California, industries such as automotive, aerospace, and plastics are experiencing rapid growth. Tesla has already announced plans for a new $15 billion gigafactory in Nuevo León, Monterrey. Similarly, General Motors, Kia Motors, and BMW have committed to electric vehicle investments in Monterrey since early 2021. With multinational companies setting up new plants and warehouses being snapped up before construction completion, dust swirls in these burgeoning industrial zones. Industrial parks play a pivotal role in attracting foreign investment to Mexico, offering robust infrastructure, including urban developments, top-notch real estate, operational services, communal areas, and internal management responsible for property upkeep and security. Over the past 2 decades, these parks have significantly bolstered Mexico's economic expansion. Mexico has established approximately 400 industrial parks, where more than 3,700 national and foreign companies from over 40 countries operate. These parks collectively provide employment for over 3 million people across a wide range of industries, including automotive, logistics, metals, electronics, plastics, beverages, chemicals, construction, and aerospace. This extensive network of industrial parks positions Mexico as a highly attractive destination for global companies aiming to establish new production facilities or supply chain logistics centers in a competitive global market. The majority of this development is concentrated in northern Mexico, while the southern region remains largely undeveloped but holds significant potential. Public investments are now emerging in the south, notably the Interoceanic Corridor, a rail link project spanning 309 kilometers to modernize railways connecting the Gulf of Mexico and the Pacific. This initiative aims to enhance connectivity between the ports of Coatzacoalcos in Veracruz and Salina Cruz in Oaxaca. Furthermore, plans include upgrading port facilities, highways, and rural roads. This strategic focus on southern Mexico aims to attract foreign investment, foster productive capacity, and stimulate regional economic growth and social development. The overarching question remains: can Mexico sustain its leading position over the long term? China has historically led global manufacturing, yet the pandemic, along with high trade tariffs and increasing wages for Chinese workers, has prompted manufacturers to seek alternatives. Major U.S. corporations like Walmart, Amazon, and Dell have opted to relocate their supply chains to Mexico as an alternative to China. For some, the heightened tariffs resulting from the trade war were sufficient motivation for this move. Concurrently, certain Chinese companies have shifted their production outside China to evade U.S. tariffs, while others have outsourced their manufacturing abroad, obscuring their Chinese origins. Consequently, products once manufactured by Chinese firms in China now enter the United States from Chinese-owned factories in Mexico or Vietnam. This adjustment enables Chinese exporters to reconfigure their global supply chains, positioning themselves closer to the U.S. market while mitigating supply chain disruptions. Additionally, China has made substantial investments in Mexico, bolstering local supply chains to navigate U.S. trade restrictions and access the American market more effectively. Chinese enterprises have committed approximately $20 billion to Mexican projects since 2008, with $8 billion invested since 2018. Mexico's appeal to Chinese firms lies in its abundant natural resources and cost-effective labor force, attracting investments from network hardware providers, oil drillers, garment manufacturers, and electric vehicle innovators alike. Nevertheless, the question remains: is China experiencing any losses? Some economists argue that amid global supply chain disruptions, countries like Mexico, India, and Vietnam are seizing opportunities and gaining a small share of China's global manufacturing dominance. However, these developments are unlikely to significantly diminish China's predominant position in the near future. Accounting for 31% of global manufacturing value added, China continues to serve as the world's primary manufacturing hub. It retains unparalleled advantages such as advanced ports, extensive road networks, high-speed rail infrastructure, and adaptable industry clusters capable of swift adaptation to evolving market conditions. Chinese enterprises will maintain their dominance in global goods markets, whether operating within China or abroad. Moreover, Mexico's infrastructure remains underdeveloped and faces substantial challenges that will take time to address. Nevertheless, Mexico's manufacturing sector is experiencing rapid expansion and development, enhancing resilience and competitiveness throughout North America. In conclusion, the establishment of robust regional value chains benefits the United States, Mexico, and Canada alike. By collaborating, these nations, often referred to as the Three Amigos, can leverage their respective strengths and establish supply chain networks that prioritize local and regional resources. This cooperative approach fosters economic integration and enhances the collective competitiveness of the North American region on the global stage.